Hi, everybody. Thanks for checking in with Lee and I. Really, in follow up to our webinar on July 31st, we wanted to kind of reconvene and pick up the conversation with how to safe harbor your project and what is beginning of construction. So I think we'll just jump into it. I should mention, Lee, will you change the slide? Because no matter how many times I say it, I like to read it off the slide. The information presented today is for educational purposes only and should not be construed as tax or legal advice. Today is August 8th, 2025. So please be aware of that when you rely or refer back to this recording. Lee, I'm sure you want to add a little of your wisdom here as well.
Well, just the obvious, I'm a CPA, but I'm not your CPA. And tax law is so facts and circumstances dependent that there are rules and there's exceptions and there's exceptions to the exceptions. And you may see something here and go, oh, we're good, or oh, we're not good, and not realize that something unique about your situation means you can rely upon one of those exceptions. So just as a heads up, you really want to go through your particular facts and circumstances with your tax advisor or legal professional. And also reiterating, yeah, it's August 8th, and all these rules are going to change. So, depending on what day you're watching this video, many of these rules may be outdated already. So, you do want to refer back to our website and other resources to make sure that the information is still timely and accurate.
Perfect.
Okay, so with that, just a quick rundown. Nicole, it seems like we're getting a ton of inquiries lately about what the heck is beginning of construction? What does that mean? It's confusing. And I think the reason it's confusing is because there is no definition. There is no like one place you point to in tax code and go, here's the citation. It's not codified specifically in code, a specific definition. What we have instead is this amalgamation of a dozen different notices over like 16 years that all kind of cobbled together represent this body of knowledge. It's a good body of knowledge because there's a lot of Q&A and there's a lot of information that's been provided over the years because circumstances happen. And then people go, well, what if this? And then Treasury and IRS will put out guidance and say, oh, well, this is how we handle that situation. And it's great. It's a really helpful evolving process. So there's a huge body of knowledge. I would focus people's attention on the 2013 29 and 2018 59 because that's where the bulk of the information is. And just recognizing that this idea of beginning of construction is not new. In other parts of the tax code that have nothing to do with solar, this dates back 50, 60 years. There's been different tax provisions that say you have to have started your construction for other kinds of assets. But for solar, and renewables in general, we actually do have a lot of information and a lot of notices and a lot of things over 16 years that we've all learned. But ultimately, I can tell you what the current state is today of everything we know from 16 years of this information. It boils down to two tests, knowing that this is all about to change. So just keep that in mind. There's two different ways to say that I've met beginning of construction. There's a physical work test and there's a 5% test. The physical work test has to do, as the name suggests, with physical work that's performed. The 5% test has to do with spending 5% on the project. And all that they're demonstrating is, hey, I've actually started construction on this project. What does that mean? And so people ask questions like, well, what if I take a shovel and I go in my backyard and I dig a hole? Have I started construction? And the answer is no, that is not the start of construction. It must be physical work of a significant nature. And there's a lot of gray area here. The physical work test has a lot of subjectivity to it. What does it mean to be significant? But thankfully, over doing this for many, many years, there's a body of knowledge that's evolved with notices and other rulings that have helped us shape this information. And it turns out physical work test is pretty good for big utility scale projects. It's pretty good if you're building a wind farm or a huge utility scale solar project. And they tend to gravitate in this direction because the feature they like about physical work is that it incorporates the manufacturing of components like transformers and wind turbines. So if you're building a big wind farm and you start work on the nacelles, you can claim I've started construction. My construction has begun because I've met the physical work test. And it's been kind of an easier pathway for them to rely on. And a lot of those projects have gravitated in that direction. For folks who are watching this video, you're probably a nonprofit doing a project on your rooftop or in your parking lot. This could apply to you. And if it does, great. But chances are it's not because purchasing equipment, buying inverters, modules, racking, those don't count. That so inventoriable goods is not physical work of a significant nature. It's not manufacturing something specifically for this project. So in the case of, a nonprofit, their physical work is going to begin when they're actually building stuff, when they're in the parking lot, pouring concrete, mounting solar modules. And in our universe, that just happens kind of later in the process. So if you're trying to get an early beginning of construction date, it's going to be harder to meet this test, except for certain circumstances where, it might be beneficial. But the key here is all these preliminary activities, they don't count. So all your planning and admin and design and permits and site prep and clearing the site. Nicole, we just got asked a question the other day of like, I've got old HVACs on my roof.
Yeah.
If I start removing those HVACs, like, does that mean I've started construction? Under the physical work test, the answer is no. So for folks watching this video, be aware this exists. There's a physical work test. You're probably not going to rely upon it. Where you're probably headed is the 5% test. The 5% test is a lot more objective because I can prove it. I wrote a check. I made a payment. Paying or incurring 5% of the total project cost is the core method for claiming, like, I've started construction. I've actually begun this project. And I can do that by simply paying or incurring 5%. Now, parsing that a little bit further without getting into a bunch of details, I say that because if you're a cash basis taxpayer, you have to pay 5%. If you're an accrual basis taxpayer, you have to incur 5%. And those rules are slightly different. Before getting hung up on it, just go ask your treasurer, your CFO, your bookkeeper, hey, are we on a cash basis or an accrual basis? And they'll tell you. And one other nuance, what the IRS cares about is whether or not you're on a cash basis or an accrual basis for tax purposes. And for book purposes, generally speaking, your tax follows your book purposes, your book method. But just know that there can be exceptions to that rule as well. And there's a bunch of rules around how that works, which we're not going to get into in this video. But just go forward knowing that as a taxpayer, if we're cash basis, we have to pay it. If we're accrual basis, we have to incur it. And the difference there is paying it is proving funds have changed hands. Your documentation is a cashed check, a wire transfer, whatever that may be. On the accrual basis, it's a little more involved because there's actually three different steps that have to happen. That liability has to be fixed, known, determinable, and economic performance has to occur. Honing in for a minute, just that term economic performance is the linchpin. Economic performance means that whatever it is we've incurred, whatever cost is incurred, we've received the services or received the goods, like the performance has actually happened. This is going to translate to paying very close attention to what your milestones are and how you've defined them. And if your milestones are written as deposits, those may not meet the bar. You may run into issues there of meeting the economic performance test. Whereas if they're written for something tangible, specific, like equipment that's delivered, a permit that's generated, an activity that is fixed, determinable, and has some economic performance component where they're performing some kind of work in order to earn that milestone, that's going to be a safer set of facts and circumstances. Again, all very project specific and contract specific. But what you're going to want to pay attention to is what are those milestones and am I on a cash basis or an accrual basis? There are exceptions. So if you find yourself like you're getting out to December and it's really late in the game, um, there are ways to meet the economic performance test by meeting, either the 3.5 month rule or the look through rule, which again, we won't get into too many details, but be aware that they exist, where if you reasonably expect the performance to occur in the first 3.5 months, you can claim economic performance is made at the time that you incur the 5% cost. But it's complicated. It's a little bit more involved. Make sure you're getting support with really good tax counsel, legal counsel to make sure you're navigating that properly. The other, so that's one big gotcha is how you define your milestones. The other big gotcha is it's only ITC eligible costs that matter. So you have to pay or incur 5% of the project costs, but ITC eligible project costs. So if you have things on your project, so this comes up, we get asked this question about roofing.
Yep.
Well, roofing in most cases is not ITC eligible. There's exceptions to that rule. For example, if you're doing structural enhancements to support additional load for the weight of the solar panels, like there could be some exceptions there where portions might be eligible, but the general rule is no, roofing costs are not eligible. So if you've paid or incurred 5% on roofing costs that are non-ITC eligible, you may not have met this 5% test, which is important. The other potential foot faults or hidden gotcha here is that you want to shoot for more than 5%. You probably want to shoot for 7 to 10%, maybe even more. And the reason is because the rule is pay or incur 5% of the final project cost, not the cost you thought it was going to be when the project started, but the final project tax basis that you're going to claim for your ITC. So imagine what could happen here if you think your project is going to be $100,000 and then you pay or incur $5,000 and you go, yay, I've met my 5%. We're good. And then what if you have a little cost overrun? What if there's a change order? It doesn't happen all the time, but there are legitimate reasons why change orders can occur. And so what if now your final project cost is $101,000? Well, that $5,000 that you paid or incurred is now 4.95% of the total project cost, and you just blew your safe harbor. So in order to avoid that in anticipation of change orders that may or may not occur, the safer strategy is to pay or incur more than 5% and shoot for 7 to 10, maybe 12, what makes sense kind of for your particular project. There's a couple other kind of broader overall requirements. One, this has to be a binding written contract. Um, so there's some nuance around cancelability, cancellation options. What the IRS is basically looking for here is that you're not just signing a contract that can be canceled later to give you the option if you want to begin construction down the road, like you can, or you can just cancel the contract. Like that's going to invalidate your claim that you began construction. You have to begin construction on a binding written contract. Otherwise, it's out the window. The other is there are some continuity tests. So continuous construction is a feature of both of these. There is a safe harbor to meet continuous construction, which is the 4-year test. But do keep in mind that you can't just go dig a hole in the backyard and come back in 10 years and say, okay, I began construction a decade ago. That's just not going to work. Facts and circumstances are key and critical to meeting all these definitions and rules. And a function of that is record keeping and documentation. Like, are you an accrual or cash-based taxpayer? You better have a memo somewhere that documents that. You should have records about what it is we're paying for, when it was completed, what work was done, every aspect of this transaction. You just have to have really solid documentation and records around so that you can demonstrate that you've met the criteria for one of these safe harbor paths. All right, so that's sort of what we know of what it means to begin construction today, based on 16 years of historical precedent and notices that we've gotten uh, promulgated, over this time. All that's about to change. So a couple days after the reconciliation bill is passed, an executive order was issued. And the executive order said, and I quoted, I encourage you to click on the link here and read it. It's not that long, but it is basically a direction uh, to create a new definition for beginning of construction. So this is an EO that directs Treasury to issue new guidance. I want to emphasize that this is trumpet noise. Like there is no reason you need an executive order for Treasury. They don't need to be told. There's no requirement for an EO for Treasury to come out with new guidance. Any day, Treasury can just come out with new guidance. Any day, Treasury can just rescind old guidance. Like they can publish what's called sub-regulatory guidance in the form of a notice, which has no comment period, which has no time bounds. It's just like as of today, like this is what our thinking is. Um, and that's the form that we expect this guidance to take sometime within 45 days or August 18th. So the week of August 18th, something's coming down. And we just don't know exactly what that will be, but we know that it's going to be incrementally bad for meeting the beginning of construction definition. We don't know if that 5% safe harbor is going to become a higher number, if that's going to become 20% or 51% or some other number. We don't know if the safe harbor is going to change entirely. Maybe there won't be a 5% safe harbor. Maybe it'll be something else. What we know is from this language that the direction is to restrict the use of broad safe harbors uh, as a general tool to what they call prevent the artificial acceleration manipulation of eligibility. So they're trying to narrow these definitions and narrow these workarounds to effectively um, limit the ability for projects to be able to claim a safe harbor and ultimately to be able to claim an ITC. So we're just going to have to wait until this notice is released, understand, we'll probably do another video to explain, and then adapt accordingly under whatever those new rules are. The potential, area to pay close attention to is retroactivity. So if the notice comes out and says this is the new definition of beginning of construction, instead of going forward from today, if they said something like, and it dates back to July 4th or July 7th or January 1st or whatever, that retroactivity component is particularly problematic because if you go to safe harbor something today, August 8th, and they say retroactively like that doesn't count, you could be scrambling towards the end of the year. Now, I would say this is unlikely, but it is possible. It would certainly be kind of a deviation from historical norms. But if you've been tracking policy from this administration, that seems to be more of an ordinary course of business. And so it is really difficult to predict. There are a number of conversations that are happening right now in DC, particularly bolstered by a number of the senators who put the beginning of construction provision into the bill in the first place because they want their will and intent to be honored. But ultimately, there is these, very varying public policy priorities that are being worked through, and Treasury will ultimately have to issue this guidance and identify, what those rules are going to be. And then we as an industry are going to rally, figure out solutions, and then meet the moment with more solutions that will provide the tools in order to meet those new rules, whatever those new rules might be. So why does this matter? Uh, because if you're contemplating a solar project, you need to safe harbor as quickly as possible. And the rules as they're written right now uh, in the reconciliation bill uh, are that ITC needs to be placed in service by 12/31/2027, or you have begun construction on or before July 4th, 2026. And that means if you reach that that safe harbor, you're going to have 4 years to complete your construction. And it's actually the end of the fourth year when you start your construction. So it might be a little bit more than 4 years. But the emphasis here is that you have a sense of urgency to begin construction by July 4th. The other sense of urgency is for the FEOC rules, which we will actually be doing a webinar on. And so you can watch that webinar with we spent an hour talking about FEOC, and we will. Those are going to be very onerous rules that will make it difficult because if you're not FEOC compliant, you lose your ITC eligibility. So the silver lining here is that you can prevent your project from needing to be FEOC compliant if you begin construction on or before December 31, 2025. So you have two different reasons, two separate kind of safe harbors to keep an eye on here, but two different reasons to start right away. As quickly as you can, begin construction. Begin construction today using your knowledge of what the rules are as of today. And when those rules change, adapt and be agile as quickly as possible to meet whatever those rules are as we understand them. But the concept of beginning of construction is critical to start now. Because if you can start between now and the end of the year, 12/31/2025, you'll have 4 years to place in service, and FEOC is not going to apply to you. If you miss that deadline, at least if you can begin construction between January 1st, 26 and July 4th, 26, well, then you're still going to safe harbor under ITC, but FEOC is going to apply to you. So you get partial victory there. But if you don't start construction until after July 4th, well, now you've missed your ITC safe harbor. You must place in service by December 31, 27, and all the FEOC rules apply to you. So no matter how you slice this, the sooner you start, the better off that you are.
Lee, when should they start?
I would say start now.
Okay. Okay. I wasn't sure. Oh, perfect.
uh, and with that, that is everything you need to know about everything we know about beginning of construction as of August 8th, 2025. Stay tuned, buckle up, as this is a fluid environment and things may change, but use this information, get your project started, begin construction either under the physical work test or the 5% test. And as always, if you have questions, reach out to us and we're always happy to help.
Perfect. Well done, Lee Barkin. Thanks, everybody.